Have you ever looked at an investment and wondered whether it's too good to be true? This episode will dive into the type of things to look for and maybe some red flags that are pretty obvious for me when I'm looking at investments to know if it's kind of a scam or not, but maybe a little less obvious to the average person. Okay, so let's talk about...
Quick question. Do we not do the hello, welcome to the Plain English Finance anymore?
No, apparently it's not very good for podcasts and intros and stuff like that.
Oh, feels wrong. It's been so long. Yeah. 50 episodes worth.
I know. Things you learn, I guess, during the episodes. But part of any podcast is getting people to listen past the initial stages. And in order to do that, you have to kind of get right into
the content
and why should they listen? Why should they stick around? So...
As I'm like, let's talk about this. Okay, moving on.
So this episode is, I kind of wanted to talk to you and get an idea of, because you didn't know what we was going to talk about or anything, but I wanted you to tell me what you would look for, I guess, if you was looking for an investment opportunity. You know this thing's changing, right?
Yeah, I didn't know how to fix it right now. So I was like, well... Let's just spice it up a little in the video this time. Okay, wait. So what was the question? What would I...
Like bent.
I don't know. That you can blame Mariah for that one because she's been in here.
Is it bent? It looks like it. Did she bend it?
I don't think so. I think it's the carpet.
Oh, okay.
Like the stand doesn't sit straight. Okay.
Right, so... investment. You're looking for an investment. What type of things are you looking for?
Low cost, broad ETF.
Just regurgitating stuff that you've heard me say. No,
Am I wrong?
What are you looking at if, let's say somebody said, hey, we're going to give you there's an investment opportunity. I want you to invest. It's a real estate. What are some red flags, I guess, or some green flags for
real estate?
Yeah, for any real investment. What are you looking for?
The numbers, definitely.
Okay, so I say, hey, we're doing, I think one of the examples I have here, they were promising 15% returns through real estate.
Mm-hmm. Who's they?
Just this company that I found. But they'd been doing it since 2013.
They'd been
investing people's money, giving them 15%. Privately.
I don't know why, but I'm just getting the ick.
Why? But why though?
Such a high return. I'm like, red flag right now. 15%, I guess 15% over how long? Annually?
Yeah.
No, something ain't right.
Why is something not right?
I don't know. I can't really tell you, but something that's too good. If it's too good to be true, if it sounds too good to be true, it probably is.
Yeah.
So I guess that would be... I don't like people promising either. Promising 15%? No, I want to see the numbers. And you know what this sounds like?
What?
I know what this sounds like. There's a company... I don't know if I'm allowed to say all this.
I don't know either, so I'm going to be very careful with what I say. I was reading the articles and it was like they got fined a bunch, and but they stopped short of saying outright fraud. So I'm not going to use that term, but
yeah, I think I know. Was the company in close proximity?
Was it a Saskatoon company? Yes.
As if anyone couldn't figure that part out.
Yeah, it's a company, they collapsed in January 2022.
I know exactly what this is.
Yeah.
And I think that's why it was like something was going off in my brain, like, this is weird, like, be careful. I couldn't remember exactly all the details, but yeah, I remember it was around real estate and promising high returns.
Yeah. So fundamentally, the reason that automatically raises a flag for me is that we live in a capitalist society. So because we're in a capitalist society, there are rules around a capitalist society. One of those rules is if money can go somewhere and earn a high return with low returns, it will do it, and it will force the returns lower.
You're going to have to regurgitate that one.
So there is no such thing as return without risk.
Yeah.
Okay.
For sure.
As soon as there is something that is return without risk, all money will go there, which will reduce how much return something needs to pay for that said thing, right? Because nobody's going to overpay somebody to borrow money from them. Nobody's going to do that. That's the way capitalist society works, and that's the way that our money works, is that nobody is going to overpay for no reason. Therefore, all else being equal, very likely the risk is very closely tied to the return that you are getting. Okay, so there's no such thing. Everybody wants it. Everybody would love to have high return, low risk. It doesn't exist in a capitalist society, because as soon as there is any sniff of high returns with low risk, all money floods there, which means that whoever's providing those returns doesn't have to pay as much. Therefore, it will reduce the cost. That's just the nature of it. Why are you smiling so much?
Sorry.
You just smile like a crazy person.
I'm thinking of the stupidest joke right now, and I don't want
What? You smile like you're gonna lose your mind. Just like,
I am. I'm trying.
what was you gonna say?
I'm crying right now laughing.
This camera angle was really bad as well, I think. Yeah.
Anyways,
What was your joke?
I was gonna say, so would you say like no risk, no reward?
That was your
it.
joke?
That was it. And I was thinking, this is so stupid, but I wanted to say it. But then you just kept going and anyway.
Boy.
Can you tell we're like so... Once again, we're sick. It's 2026, and this is, I said to Trey, the 4th time I've been sick. I've been sick more this year, I think, than I've been well. I realized today, I was like, I think I've actually been sick more this year than well. Anyways, sorry. But that's why I'm a little... that's what I'm going to blame it on anyway. I'm like, I'm in a goofy mood again. Sorry.
Okay, so a big red flag for me is returns that don't make sense for the market.
Yeah.
Okay, so especially when it comes to real estate, it means that in order to get those type of returns, it means that let's say it's mortgages. Let's say you're saying like mortgage debt, and you provide loans to people to cover their mortgage. And you're telling me that there's people out there, there's companies out there that you're telling me you can get 8% rate of returns on a mortgage.
I'm like, that all went right around. I'm like, don't laugh, don't smile, don't laugh. And so I missed okay, red flag, rate of return. That's what you were saying.
Yeah, so a major red flag for me is when they're offering rates of return that don't make sense. There are debt companies out there that are fixed income companies that are saying that they can get 8% rate of return on mortgage debt. It's not going to happen. Who in their right mind is paying 8% on mortgage debt? People that can't get proper lending.
Yeah.
Like that's
cash
insane
money
to
and
do.
stuff yeah.
That you would be lending, that somebody would pay 8% on debt.
Yeah.
How on earth are you telling me that you can get 8% on mortgage debt? It's just so, like, I don't care how many years of proof that you come up and show me. I know that is counter to a simple capitalist society where if you can get lower debt, it's not telling me that, it's not somebody saying that, okay, the average is 3.5%, I can get 4%. No, you're saying you can get double the rate of return of an average mortgage fund? No. Very unlikely. So there are a few things that you should look for. So first off is returns that are too high, don't make any sense. Second thing you're looking for are returns that do not fluctuate. And this was the big giveaway for Bernie Madoff.
The mortgage guy? The 2008 guy?
No, not quite. He did a biggest Ponzi scheme in history. A bunch of very wealthy people got involved in this Ponzi scheme. But the issue was that the returns were too steady. That is not how markets return. So we often say markets return, 8% on average. You can count on one hand how many years have actually been an 8% rate of return. Normally it is significantly higher or significantly lower. It just averages out to 8%. When something is returning that type of figure consistently, it is a red flag.
Why?
Because that's not how markets work. That's not how
But
companies grow. That's not, it's just not how money moves and wealth is created in a capitalist society.
Would you
It's
say-
how wealth is created in a society that is being controlled.
Yeah, that's what I was going to say. Would you say that's kind of like a red flag that they're not paying you appropriately almost?
Both. It's a red flag that they're either not paying me appropriately when the investments are returning more, and that they're making it up when the investments are returning less. Right? It's not. It's comforting. I'm sure it'd be very comforting for money to go like that way, but that's not the way that it works. That is just fundamentally not how a capitalist society works. That's not how money functions. So the expectation that suddenly this one individual has found this miracle way to do said thing, I'm sorry, but your $1 million, your $2 million, your $50,000 is not the type of people that this individual would be dealing with if they could do that.
Yeah.
Like if they could genuinely do that and they could genuinely go earn 8% a year on investments, CBP, Canada Pension Plan, has averaged like 6. Go work for them and make $1 billion a year and set for life. Like there is plenty of money out there that would love if you could genuinely do that and prove it. Love for that type of thing.
Yeah.
They're not doing that because they can't genuinely do it. There's more to the story. Okay.
Yeah.
So unusually high returns are too smooth. Speed. So this is really common with even scams where they will create a sense of urgency.
Yeah.
That you have to act now, because the faster you act, the less you'll actually think about it.
Yeah.
Right. A lot of people, when they're caught in scams, when they're caught in like bad investments that like clearly were like fraudulent investments, not just, it lost money, but like fraudulent type investments. Oftentimes there is a sense of urgency around it.
Yeah.
That when you look back, you think, oh, how did I miss that? But it's the urgency.
Yeah.
You create a sense of urgency and then you act on that. And
Because there's something inside you that's like, I don't want to miss out on an opportunity
absolutely,
either.
yeah.
And sometimes there is an urgency to certain things, but yeah, is it worth the trade-off of what if this is... And I guess, yeah, when would that happen with investing money? I could not see it ever being urgent like that.
Not in that sense, yeah. Not in that sense.
Yeah.
And if it was, it would be, I can only think of a handful of scenarios where you could genuinely lose an opportunity if like somebody is raising money for something specific. But again, if you're investing in something and you cannot afford to lose the money, you shouldn't be investing in it in the first place. So those type of investments are not for the vast majority of people.
Well, so what is a fraudulent investment? You said, what's the difference?
Where they're misrepresenting. So there's a difference between somebody like you invest in a business and the business goes under because the business goes under. That is very different than...
That's just a bad investment.
It's bad investment, yeah. It's like that would happen depending on the type of investments that you pick. That's very different than somebody misrepresenting. Like a Ponzi scheme, a typical Ponzi scheme is like they're misrepresenting the facts and paying investors with other people's money instead of the return that their investment strategy is earning.
Is that the same as a pyramid scheme?
Yeah. Yeah, same thing.
Yeah.
Yeah, pretty much same thing. Yeah.
Because I always try to figure that out because there's a lot of companies that I'm like, I'm pretty sure that's a pyramid scheme. I'm not going to call them.
Some of them call them multi-level marketing.
Yes, MLMs. Which I'm like, and then it's very.
I don't know what the difference is. I've looked, I've researched. I do not understand what the difference is between them. I really don't. Like,
it seems like a common thing, like not to call out anybody specific, but I've noticed a lot of women get involved in these MLMs they're like targeted. It's either skincare or makeup, food products, like those things. I'm just like, I've had
a lot of them are sold
products.
to people as get rich quick type schemes.
Yeah, similar. Yeah, it's like, oh, I've made this much money. Like, I want you. It's like we're friends. I want you to do that too. I just remember there was a time where this one product / company was getting really popular in like people I knew, and like 4 or 5 people came to me and were like, you should start selling, like, you need to sell this product, and like reaching out to me. One time this girl from high school who I hadn't talked to in years and years reached out to me and called me and was like, oh, you should get involved in this. And I'm just like, what is this? That kind of stuff immediately, like,
sketchy.
Yeah, sketches
Stay
me
away.
out. I never was, like, even back then, I was a lot younger back then and more naive, but I remember just thinking, like, something about this just doesn't feel right. And I mean, not that I wouldn't fall for it, I guess, but I think once you're exposed to enough, like, I worked in banking, so thankfully I had a lot of like fraud training and that kind of stuff. I think those things do help because I didn't understand.
I hate doing them. Oh my gosh, I hate doing those type of things.
The phishing emails,
all that stuff. But yeah, for sure now I'd see an email
because something in you is just like, this
immediately,
because
you just have this thing at the back of your head that just says this is wrong.
Yeah,
absolutely.
I guess the training worked.
I guess so. Yeah.
Guess the security team gets a little bonus this year. Just kidding.
We now get like the random email that if you don't hit it as phishing, you'll have to do extra training on it now.
You can't just ignore it.
And then you fish, and then you hit it and say, well done, this was sent by your IT department. Then you're like, dang it, now I have to make sure that I actually hit the phishing button. Because with my email being out there in the world, the amount of garbage that comes through my email is unreal.
Yeah.
You get very good very quickly at just like knowing what gets ignored and junking it and getting like, because the amount of, I'm pretty sure AI has had a part into play in it as well, where it will go and crawl the internet for emails,
like lists and
lists
stuff.
Of emails.
Because once for sure, once you've put your web or
unreal.
your email address out there, it can do that.
Yeah.
Okay, sorry, keep going.
Anyway, another thing would be a major thing is hard to understand strategy. If you cannot understand the way that this is making money, stay away from it.
Yeah.
Also important thing that you need to understand is how do you lose money? Okay, that is a really, really important thing to understand. There is no such thing as an investment with no risk. People might think to yourselves, hey, aren't GICs no risk? No, GICs are. There is a reason that the government insures them up to a certain dollar figure. And if you're with a credit union, it's slightly different. But with a bank, the government only insures up to a certain dollar figure. Why? Because the risk is that company goes under, right?
What company? Sorry.
The bank.
Oh,
right?
Just the bank.
The bank, yeah. The risk is that's what a GIC is, a guaranteed investment certificate. But who is doing the guaranteeing? Well, it's the bank doing the guaranteeing.
Yeah.
And to make people feel even better, there's another layer of protection there where the government will back it because they can just print money and guarantee it that way if something happened. But the fact is that the Canadian banking system is very safe. But there's always risk. So if you're putting your money somewhere, you must understand, how do I lose money in this? And if the answer is nobody loses money in this, there's no way you can lose money in this, run.
Yeah.
Doesn't exist in a capitalist society. Does not exist. And that's what people, I think a lot of the scams and the fraud and stuff that is out there is built on the back of this idea that you're special, that you found this special loophole that nobody else knows about.
Yeah.
Not how a capitalist society works.
I know. Don't you just want to believe you're the one? You're like,
that you know something that everybody else doesn't know. The only way that you get significantly crazy returns is business for self.
Yeah.
Right. If you go and build a business, absolutely you are entitled to. You could expect crazy returns from your money. If you are paying somebody to go find a business for you to then invest in, that's all gone. Doesn't exist anymore. And that is repeated even in real estate. It's like real estate is a great wealth building tool. As soon as you are now paying somebody to go find a deal in real estate and now everybody's getting their slice of the pie, it takes it from a wealth building tool to another average investment with average returns, because that is the nature of a capitalist society. You do not get something for free. You have to go do the work yourself.
Yeah, somewhere there has to be work done.
Yeah.
Like if you own the business, people might be like, wow, you're getting crazy returns. And yeah, some people do I don't want to say luck out because they still did the work, but sometimes the returns are a lot higher depending on.
Oh, they're absolutely. You can expect that though. But let's say me as a business owner, I'm getting these crazy high returns, and I want to bring in a silent partner with money, and all they bring to the table is money. I want to pay that silent partner as little as possible. Why would I give up more of my business than I have to?
Yeah.
To raise money?
Yeah.
Nobody in their right mind is going to do that.
Yeah.
And that's what a capitalist society basically fundamentally says, is that nobody just willingly, out of the goodness of their heart, throws away money. So because nobody is willingly just throwing away money, it means there has to be a break-even point, that an amount that if I'm going to attract a silent partner in my business, that I have to pay.
Yeah.
An amount that a silent partner should expect, and that power will eventually come together, and that's kind of the price that I will pay.
Like
I'm
a
not gonna
fairness of some sort.
yeah, like an equilibrium. I'm not going to pay significantly more just for the sake of it.
Yeah.
Let alone pay thousands of people significantly more just for the sake of it that I don't even know. Like, no, it's not how it works.
Yeah.
So if somebody is saying that's how it works, they're wrong. Stay away from them type of investments.
Yeah. No one's your GoFundMe fund.
Basically.
Yeah. You're not a charity.
Okay, last one is difficulty when withdrawing money. So there are types of investments that we call illiquid. So they can't just be sold and bought easily on the open market and things like that. The issue comes, again, vast majority of people should stay away from this type of stuff. But the issues come when, yes, there being restrictions on how fast you can withdraw your money is to be expected in certain types of investments. If you're investing money that has any chance that you would potentially need that money, then you shouldn't be using those type of investments. It really is that simple. Like, lockup periods are there for a reason, and yeah, maybe throughout history they haven't used them. We just went through, like Canada just went through a ton of them, where investors couldn't get their money out of these private debt funds and stuff like that because too many people were taking the money out, and they have every right to just stop. We're just not paying anybody back at the moment. Terrifying. And while definitely doesn't equal the line of fraud type, it's not fraud at all. They're very upfront about it.
Yeah.
Definitely scary enough for me. Ain't touching it.
Yeah.
Not gonna touch it. And the real question comes into if I can get reasonable market returns that exceed whatever they could promise me, why would I add that extra risk in there?
Yeah.
Like, realistically, why would I? Because the issue is that in order for the market stuff to perform very poorly, it means likely is tied similar to like what the economy is doing and things like that.
Yeah.
Guess at what point those other types of investments are going to do really poorly. Same type of environment. So you're not really protecting yourself from those type of environments by just adding this extra illiquidity risk.
Yeah. It's not a diversification.
Not like some people think it is, right? Yeah. It's just, and some people get way too tied on the fact that it drops volatility, like it drops the ups and downs of a portfolio. But here's the facts. If you only value an asset once a year, it's going to seem like it doesn't move at all, right? Or in one direction. So your house, how up and down is the value of your house? You only really know when you go to sell it, right? And you couldn't get an appraisal done, but nobody's out there getting an appraisal done every week to determine what the value of the home is. So it seems like it's very steady.
Yeah.
Well, with the markets, it's valued every second of every day. So therefore, you see a lot more volatility. But just because you don't see it, just because it's not valued, doesn't mean it's not there.
Yeah.
And that's kind of the loophole that a lot of these private type investments jump through, where, well, it's not valued every day. We have to sign a value onto it based on good accounting principles. Well, good accounting principles has a wide range of more than I would be comfortable with. So my question is always the same: is it worth it?
Yeah.
Is the juice worth the squeeze, as it were? You never heard that saying?
I don't know if I don't like it though.
Why?
I don't know. I just do not like that. Are you looking it up?
Yeah, it's a saying.
I believe you. You know a lot of like random sayings though. Sometimes I'm like taken aback. Is it taken aback?
Taken, I don't know.
Anyways,
I don't know where it's from.
is the juice
Word
worth the
histories.
squeeze?
I don't know. The idiom.
It makes sense.
It's an idiom.
It makes sense. I'm sure a lot of people like it. It's a no for me, but
Okay. So that's kind of what I basically was, just to get people to think about these different type of investment opportunities that often come along. You have to really make sure that you understand it, and you have to remember the way that a capitalist society works is that you do not get excess returns for no risk. There is always risk. And if somebody is offering you excess returns than the risk that it looks like, there's more going on. There's more going on because there's so much money out there. I know it seems like even to an individual, they made whatever they have seems like a lot of money to them. There is so much money out there sloshing around looking for places to invest. Don't like that one either.
I didn't like that. I don't know why. I'm just like, some of these choices of words are like not good. Money sloshing around.
It's true. There's so much money out there that just wants somewhere to go that will fill that gap. If you have a good enough investment opportunity, you'll find money for it.
Yeah, for sure.
And there's so much money out there that you're about to find money for it. So somebody significantly overpaying double what the market rate is for money, sketchy. You wouldn't trust it. Never trust it. So
yeah. Okay.
But yeah, that's that. Thanks for listening. Well,
do we know what the next episode is yet?
I refuse to say next episodes anymore because I just mix them up and mix and match them.
Okay.
So yeah. Anyway, we will see you guys in the next one.
Bye.
Bye.
Thanks for listening. Plain English Finance Podcast.
Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities are offered through Aviso Wealth, a division of Aviso Financial Inc.